Good morning to my friends in Wisconsin. And I remember being in Milwaukee all too long ago. I typically do a live speech in Milwaukee once or twice a year, overlooking the 3rd Ward from my offices in Milwaukee, and hope to see you in person next time. But today, we're going to talk about the way forward. And the way forward is my way of talking about where we are today in commercial real estate and where we're going. We're going to start off from a macro perspective, talking about the big picture, and then we're going to get right down to it. What are the major issues being faced by commercial real estate? So Kevin, nice job. Thanks for passing the baton to me, and here we go. So the way forward. The number one question in real estate right now is, what commercial real estate do we want? And what commercial real estate do we need? Well, folks, look, I've been talking about this question now for years. And the bottom line is there's really only 2 forms of commercial real estate you need. You need housing and you need storage. Everything else is a want of some sort, whether it's a restaurant, an office, or a hotel. Now, that sounds like I'm throwing real estate under the bus. I'm doing exactly the opposite. Because people want to be in offices, they want to be in restaurants, they want to be in hotels, and they always will once we get past this pandemic. Why? Why will people go back? People will go back because it makes them better. It makes them more productive. It makes them happier. Look, folks, I'm speaking to you right now from my home in Baltimore, Maryland. I'm happy, but I'm going to my office tomorrow in Baltimore, and I'll be happier. I'll see my colleagues. I won't have to worry about my dog running in and out of here. Oh, I love my dog, by the way. I don't have to worry about my Wi-Fi getting weak because I got 3 kids upstairs doing remote learning. I want to go back to the office. I miss my favorite restaurant. I miss my favorite hotels driving around the country. The bottom line is, once the pandemic is past, the future of real estate looks a lot more like the past than something else. Now, we did a survey recently of the largest commercial real estate owners in the world. And what we asked them was, well, how are you going to use real estate going forward? Well, bottom line is most of them are going to keep it about where it is with a slight decrease in the amount. Now, I will tell you that we just recently did another survey, and we call it a longitudinal survey, where we look at it over time. And the results in the most recent one weren't quite as favorable as this. People were more pessimistic about the future of office. But the bottom line is, whether it's 5%, 10%, or some other number of the decrease in aggregate demand, it is still going to be strong aggregate demand like we've seen before, but it's going to change, of course. What's going to change? What's going to change is you're going to see better wellness in the space, not dissimilar to so better security post 9/11. You're going to see better ventilation. You're going to see less density, not only in the common areas, but in the tenant spaces as well, which will counterbalance to some degree the fall off in aggregate demand. Now, why am I so confident about the future of office? Well, I'll tell you why. Because Stanford came out with a great study a couple of years ago, which measured how effective work from home was. Their subject was a Chinese company that was in the travel business, kind of like an Expedia. What they find? Nothing surprising. What they found was that people could be more efficient working from home. The company could save money on not using real estate costs. People could produce a lot of stuff, but they lost a lot too. So here's a couple of interesting findings from the Stanford study. Number one, 2/3 of the people who had elected to work from home decided to go back. Number two, the people that worked from home felt that they had a disadvantage from learning the communication skills they needed, the social skills they needed to advance. And number three, there was a marginal damage to their ability to get promoted. That on top of the fact that the company wasn't able to create the culture they wanted. So this is the deal. It is going back to want versus need, and it's productivity versus efficiency. Yes, work from home can be efficient. And yes, it's good to have a so-called fluid workplace where you can work from home, where you can work from the back of a Starbucks, where you can work from the back of a self-driving car. But it's also good to have everybody in one place. And you'll see many of the largest corporations in the world, while they're saying you can work from home, many are saying come back because people just aren't as productive. Now, there are some changes from the pandemic. One of the changes is the move to the suburbs. And so one of the things that's doing very well are single-family home sales and single-family rentals. Because one of the temporary, at least temporary shifts of the pandemic is people are moving out to the burbs because they don't have to deal with density. They don't have to deal with public transportation. And if the restaurants and the shows are closed anyways, why live there? I was on the phone yesterday with one of my colleagues in New York City. His landlord offered him a $500 a month discount to stay in their apartment in New York. He said, no thanks. He got a 50% reduction by moving to San Antonio and got a house rather than a one-bedroom apartment he was sharing with another guy. So his quality of life is going to improve by having moved out of the big city, at least temporarily. Now, is this a permanent shift? Well, you should know that demographically, people have been shifting to the suburbs for a long time. A lot of people say, oh yeah, the millennials, they'll always be in the city. Well, they've been moving out of the city and have been primarily moving to the suburbs for the last several years. So this has accelerated the trend. Now, that is the term we use, acceleration of trend. Will it be permanent? Well, I'll give you a case study. About 20 years ago, two of the largest banks in New York decided to build million-square-foot facilities just outside New York in Stamford, Connecticut, right on the train line, taking them right to the city. They said, aha, this is the solution. We'll have our younger folks reverse commute from the city, and our older folks, they live near their houses out there anyways. What a perfect answer. Not perfect. Why? They couldn't attract and retain talent. Nobody wanted to work out in the suburbs. So guess what? They largely abandoned these facilities and moved back into the city. So this is the deal. There are some shifts that are permanent, and some of the shifts that are permanent have to do with the location of people in the country going to certain markets like the southeastern United States, like Texas, that have a lower cost of doing business. But there are things that are not as permanent, which is the move to the suburbs, even though in the short term, home sales are off the charts. So my last talk about big cities, and yes, Milwaukee would qualify as a big city too, is cities aren't dead. New York is an awesome place. Milwaukee is an awesome place. I've been there many, many times. And it's awesome because of the changes that we have seen in the city and give it a terrific live, work, play environment. I mentioned the third ward, which is right across the street from my office, right across the highway. You can see it from our top floors. Milwaukee will be just fine going forward, even though there'll be some people living out in the suburbs over the long term, and they would live there anyways because they're getting older, they're having kids, and their choice of schools is what's driving a lot of the cities. There's another reason why people are going to go back to the big cities, where they're going to go back to offices. As I mentioned, going into the office makes you more productive. It makes you happier, it makes you better. And according to our friends at the Harvard Business Review, great companies obsess over productivity, not efficiency. The economy. Well, that one picture of a COVID cell kind of sums up where the economy is right now. We had been predicting since the beginning that the economy would be in an optimistic or a V-shaped recovery. And so far, we're largely correct. Not totally correct, but largely correct. And why does that mean? Well, you've seen the jobs reports from June, July, and August better than expected. GDP was slightly better than expected. The stock market has performed way better than expected. What hasn't done as well is we haven't gotten to that reopening phase when we thought we would. When we were originally talking about this, we thought we'd be back in the office in June. Then we thought we'd be back in the office in September. And I note I am personally going to my office tomorrow, first time in 8 months, but I had to make an appointment, and I had to, we only have about 20%, 25% capacity, even if it's that much to get into the office. But we will get back to the office as the virus gets under better control. But the good news is the government has stepped in and saved the day. So without the government support, we'd have nothing right now. We'd be in a very, very dangerous place, candidly. But because of the massive amount of government support from the Fed, from the Treasury, from foreign governments, we're in a much better place than we would have been because they raised the bottom. The PPP, payroll protection plan, unemployment insurance, can't tell you how important that was to keep the economy alive. And I have a picture there of Ben Bernanke and Jerome Powell. Ben Bernanke sort of was the guy that started the whatever it takes approach to save the economy during the GFC. Jerome Powell doubled, tripled, or quadrupled it now, knowing that they had to pour money in to keep the economy going during the shutdown. And so the shutdown is still ongoing in whole or in part, and we're seeing places like England, they may pop up and have additional shutdown going forward, which is causing greater uncertainty in the markets. But the good news is government support saved the day. It wasn't perfect. We need more. And in fact, I spoke to the Treasury about a month ago, the two leading folks from the Treasury Department on commercial real estate front. I told them point blank, we need more. But unfortunately, the thing that we probably need the most, or at least a segment of the market needs the most, which was called the HOPE Act, which would have saved conduit borrowing, retail, and hotels, that is unlikely to happen. It's unlikely to happen because we are going to see it was too inexpensive. Rather, the preferred equity in the deal was only about 2%, and the Treasury said, you know what, this is not in the best interest of the U.S. So there needs to be another bailout, but it's not going to be the HOPE Act, unfortunately, for CMBS. But what happened? So because of that, the size of the Fed balance sheet has gotten a whole lot bigger. And, you know, that's a problem. People don't like the government having too much debt. But as opposed to the alternative of not spending, it's way better. Spending, while it's bad over the long term, in the short term, is absolutely positively necessary. And you could see that one of the effects of it is the stock market has done well. And in our industry, REITs have done relatively well, but it's not the tale of all REITs. It's REITs in certain sectors. So industrial REITs have done well. Self-storage has done well. But when you get to the bottom, you get, unfortunately, the groups that you are all too aware of. Malls, hotels, retail, and then office is somewhere in the middle there. Surprisingly, office has taken it on the chin. Maybe not surprisingly because of the work from home thing, but surprisingly because that is by far the biggest commercial real estate asset class. Now, let me give you a couple of green shoots about the office beyond just what I've said about efficiency and productivity. Look, folks, my computer is like a pinball machine. I see deals that happen on a daily basis every single day. And what I've seen in the last couple of days are 3 very large deals in large markets being bought by foreign investors at cap rates, one of them with a 4 handle, 2 of them with a 5 handle, that are at or very close to pre-COVID pricing. Now, this is the best assets in good markets, but nevertheless, it shows that for the best assets in good markets, cap rates haven't moved that much, and values are going to be better than you think, though there will be some fall off in value for multi-tenanted buildings with roll, because people can't underwrite as high of a rent. They can't underwrite the speed at which it will be re-tenanted. Now, where is it from a GDP standpoint? From a GDP standpoint, CBRE is about negative 4.8% this year, positive 4.8% or so next year. We're kind of in line with everybody else, and you can see there are some that are more optimistic than us. Goldman Sachs at around positive 6%. The bottom line is this. The consensus is we will bounce back, and we will bounce back strong next year, and we will have a strong 2022 as well. But what does it mean? We spent a lot of money, and our debt to GDP keeps going up. Nobody likes debt. I don't like debt, but I'll tell you what, I like debt more than I like a stagnant economy. And so spending all of this money, while not a good thing in the long term, is a necessity in the short term. In fact, I had a debate the other day with a member of President Trump's committee to reopen the economy. And the debate we had was this: isn't this going to unleash inflation? Isn't this fiscally irresponsible? And my answer to him was, the biggest flaw of the global financial crisis was when the EU put its foot on the brakes too soon. And so when that happened, they had a tremendous problem. So the advice I gave to this gentleman was, what the U.S. should be doing right now is backing up the truck. Spend as much money as possible to support the economy, and we're going to need more money specifically targeted at small business. And guess what, folks? We're fighting at more money specifically targeted at commercial real estate. So back up the truck is my answer. Now, holding up the bottom. This is a picture, I guess, of Atlas holding up the world. Well, that's what the government did, as I talked about before. How did they hold up the world? They held up collections. So this is our collections through August. And you could see that even though August was not a great month, we were down in just about all the asset classes. You can see that we were still at the 80-90% range, pretty much across the board, including in retail. Yes, retail is bouncing back as well in terms of collections. Now, the one area that may surprise you in terms of some of the weakness is multifamily. And the reason why multifamily is showing relative weakness goes right back to the short-term problem I've mentioned about New York and other major markets. People can't get around, and people don't want to spend $5,000 for a one-bedroom apartment if they could spend $2,500 to get a full house in San Antonio. Bottom line is this: big market, CBD, multifamily is going to suffer in the short term on a comparative basis to the suburbs. Over the long term, they will be just fine. I was on the phone yesterday with a big investor in New York that's putting a mezzanine loan on a multifamily building in the city. And he says, is this a good time to get in? I said, it's a great time if you can get in at value, because the long-term prospects of the big cities like New York and, yes, Milwaukee are very strong once we're past the pandemic. And the government support, however, is what caused collections to be so good. And we need more government support if collections are going to continue. There's an elephant sitting in the corner of the room there, folks. It's called the election. And the election is what a lot of people are talking about, how it's going to impact not just the social issues, but also the economic ones. And certainly there are incredible social issues that impact all of us. I'm certainly keenly aware, and the world is keenly aware of the terrible events that happened in Kenosha, the events that have happened in Minneapolis and elsewhere. And these are important issues. But what I'm going to talk about today are the economic issues and how they may impact our industry. So from an economic perspective, we believe that there is not enough difference between Biden and Trump for economics to necessarily sway you towards one or the other. What do I mean by that? Because in some cases, Biden might be better in the short term. From an economic perspective, Biden is going to be more stimulative to the economy. The difference between the Democrat and the Republican bills right now is about 1.5 to 2.2 trillion. And if there is a Democratic sweep, I wouldn't be surprised if it gets up even bigger to $3 trillion. Bottom line is this: in the short term, the Democrats would be more stimulative to the economy overall than the Republicans, who would likely be closer to that 1.2 to 1.5 trillion dollar range. And why is that important? It's important to cities, particularly big cities like Milwaukee, like Chicago, like New York. Why? Because one of the key areas of bailout that's being talked about today is for state and local governments. State and local governments have had fiscal problems since the beginning of time. It only got worse because of COVID. But here's the deal: who is the best choice for many of these governments to try to get taxes from if they're broke? Commercial real estate. And so I'm friendly with the head of tax collection in Chicago, Fritz Kagi, and we have nice conversations about this, but there's no doubt about it. In the event that there's a fiscal crisis within the state or local governments, it's going to hit our industry, which brings me to my key point. Key point number one: the results of the presidential elections historically have not had great impact on returns or volumes within commercial real estate. And it's the same thing as we would expect here, because while the Biden administration might be more stimulative in the short term, over the long term, they probably would raise taxes more. There'd be more regulation, and there would be implications for different industries that are politically sensitive, like the military, like healthcare, like oil and gas. So it's a give and take, good and bad, short term, long term, which is why we are not saying Trump or Biden, one is better than the other from an economic perspective. What we are saying, though, is based upon our studies looking at the commercial real estate industry going back 50 plus years, we know that there isn't much impact on real estate overall. What does have impact, however, and however is my least favorite word, which I try to get out of my diction, is local politics. And so some people have suggested, including me, that the United States is being split now between the United States of Texas and the United States of California. What does that mean? It means that those states that have less regulation, lower cost of doing business, lower taxes are disproportionately getting people, getting companies to come there faster than those other states. And this shows up in the numbers, because if you take a look at the recovery by market in the past cycle from the global financial crisis, you'll see that most of the markets at the top of the screen, those that recovered the fastest, Houston and Dallas, recovered way faster than markets at the bottom, like LA, like New York. And so the bottom line is that not only will you see more demographic shifts to many of these markets, you're also seeing a faster recovery. And so some of the things you should be watching out for include changes to local property taxes. Like in California, there's what's known as a split roll, taxing commercial more than they're taxing residential. And also you should be looking out for rent control. And look, let me be clear when I talk about rent control. I am a big affordable housing advocate. Make no illusions about that. I advocate for it every day. But the bottom line is rent control does not increase supply of affordable housing. And so there needs to be other things done to increase the supply of affordable housing, like what was done in Minneapolis. They changed their zoning laws in the downtown area so that single family areas can go vertical. I think changing zoning is the key to be able to create more affordable housing, not rent control. But in the face of rent control, you're going to be faced with a diminution in the value of a lot of multifamily, as you can't raise rents to market. Capital markets, what's going on in terms of deal flow? So let me give you the big picture. So the big picture is this. Capital transactions are down 40, 50, 60% overall. And debt and capital markets, debt and structured finance is not down quite as much. But the two areas of strength are the same areas of strength in both sales and finance, which is multifamily because of Fannie and Freddie, and because of industrial and a great strength there. And so those are the two areas where we're seeing not only the fastest fundamental recovery, we're seeing the fastest amount of sales or the most volume of sales, and we're seeing the greatest volume of debt and structured finance. This shows up in the numbers. When we polled our professionals in a recent poll, what are we going to see the recovery the fastest? Industrial recovery in 1 to 3 months. Let me be perfectly clear, folks. Industrial is recovered. I just spoke last week to one of my great colleagues in New Jersey, Mindy listener, and she was telling me that land prices for industrial are double record levels, that rents are at 50% above previous record levels, and we are seeing sales prices at record levels. In industrial today, industrial's recovered. Multifamily is going to take a little bit longer to come back, but as I suggested, we see the greatest challenges right now in CBD areas, less challenges in other areas, in the suburban areas that don't have a density problem. But then everything else is going to take longer to come back. And not on this chart is retail and hotels, which is going to take even longer. We'll talk about that more in a moment. Now, if you take a look at the number of CAs, confidentiality agreement side, this is what I consider to be the single best green shoot in the market. What is a green shoot? A sign of optimism. Why is this the best one? Well, it shows that the amount of money in the market, the money that's chasing deals, is not quite, but really, really close to back to where it was at peak levels. That's a very good sign. So we don't have a liquidity crisis per se. We have some segments of liquidity crisis in hotels and retail, but we don't have a liquidity crisis overall, as equity prices or the amount of equity is coming back to levels to what we had pre-COVID. What is not coming back are the number of deals. We are down, as I mentioned, 40, 50, 60% in terms of the number of deals that are coming back to the market. Now, I want you to notice one jog in the line right there. You'll see a jog in the line around middle of June. Well, what happened in the middle of June? Number of new deals flatlined. Why? Mobility. People can't get around. People can't kick the bricks. We're still in a physical business, folks. If you can't kick the bricks, people can't get there. But as I mentioned a moment ago, I'm aware of 3 very large deals, all in that $500 million plus range where people are buying deals with 5 handles from foreign countries. And so it's the ability to see assets, to underwrite assets, that is the issue, not necessarily the desire to buy those assets. Now, there is one other fundamental flaw. Well, buyers want a discount, looking for discounts. That's the blue line. The orange segment of this Pac-Man pie is the sellers willing to give them. Well, you know what that leads to? It's called a bid-ask spread. So until there is capitulation by sellers, you're going to see very low deal volume. Now, we have seen capitulation in the hotel space. That is the one segment of the market where I've seen capitulation, not only from very troubled borrowers handing the keys back to lenders, but also from folks that are selling these assets prepared to give discounts. I'm aware of several deals, including one right here in Baltimore, that traded at almost a 30% discount to its pre-COVID pricing. That's not the case in the other asset classes. Look, folks, in industrial, cap rates are at or below. Did I just say that? At or below where they were pre-COVID. And multifamily, we're seeing, for the best stuff, stable cap rates. Though, as I mentioned, we have seen some NOI decreases, so we are seeing some value fall off there. This is what values look like. You're going to see a significant value fall off in 2020. And the value fall off in this chart shows a lot of it's going to come from cap rates, but the bottom line is the value fall off is going to come from some fall off in cap rates, but most of the value fall off is going to be the fall off in income. So I slightly disagree with this chart. I actually think the light green is going to be bigger than the dark green, because if you take a look at the amount of cap rate expansion, it's just not going to be that much. We expect it to be relatively moderate across the board. And as I suggested, while this one shows a modest increase in industrial cap rates, this guy doesn't believe that. I already see it as flat to down for the best stuff. We do see a cap rate expansion in office. We do see cap rate expansion in retail. Now, one of the big, really good pieces of news for our industry is hedging costs. Hedging costs have come down. Now, hedging costs sounds like this fancy financial thing, but if you want foreign money, you want low hedging costs. And if we go back to November of 2018, which is about the peak of that line right there, you'll know that it costs about 3.5% per dollar per year to buy stuff in the U.S. Now it's down to, you can see, about 1%, and in some cases gone negative. Bottom line is the U.S. is on sale. U.S. is always a place of safe haven for money to come into. So the U.S. not only is on sale, it's a safe haven. Foreign money is going to help us come out of this mess faster than it has in the past. Acceleration of trend. What is the phrase you keep hearing a lot of nowadays? Acceleration of trend. What it means is there's been a lot of things that were afoot prior to the crisis that have now gotten faster, and some of them you're well aware of. The demise of the secondary market mall, the challenges of secondary market big box power centers. Okay, guess what? That was coming anyways. We saw it coming and it got worse. And so what we're seeing now is changes. Some of these malls, and I have a whole spreadsheet on malls that are being converted into industrial. What I also have are examples of large landlords buying large retailers. We saw Simon and Brookfield team up to buy JCPenney 2 weeks ago. I believe they previously teamed up to buy Brooks Brothers. So what we're seeing is a change in the relationship between landlords and tenants. And that change in relationship isn't just going to mean more percentage rent versus base rent. What it's going to mean is that people are going to have a more 360 relationship, where maybe landlords get a piece of the action online, not just a piece of the action for rent and or percentage rent for sales in stores. And I think that even though JCPenney and Brooks Brothers will probably end up paying traditional rent, the landlords are going to be owning these companies and they're going to get percentages of the sales online. So I wrote a blog probably about a year and a half ago, which I call The New Rent. What's new rent mean? It means a new relationship between landlords and tenants in retail. And we've seen other accelerations of trend, and we'll talk about those in just a moment. But the first thing I want to talk about is what I call my 3Ds: durable, demand, drivers. I was going to put a picture of Underdog on here for all the people that are my Gen X vintage. It's a cartoon I used to watch as a kid with a big D on his chest, but I went with 3 Ds: durable, demand, drivers. These are the things that matter for large occupiers. These are the things that matter for large investors. And what's really interesting is when I speak to large investors, and believe me, I speak to them every day, they are some of the simplest thinkers you can imagine, because what they think about is like, what's going to create value over the long term? What's going to create rent growth? That's it. I have some investors that only care about that. If you can't get me to a model of rent growth, I'm not interested. Now, there are some investors that are value investors. Like, you know what? I'm not going to get any rent growth, but I'm getting in at an 8-9 handle. I'm going in. I get 50% debt. I got 12% cash on day zero. That's a good thing. That's for some investors. But some investors want that rent growth because they want both the top line and then some cap rate compression to drive value. But what are these durable demand drivers? Well, the durable demand drivers are movements to markets where we're seeing folks wanting to put their businesses. So you take a look at Seattle, San Diego, LA, Northern Virginia, Indiana, and look, Chicago right down the street. And that should get your goat, because Milwaukee, you should compete with Chicago, but not necessarily in a negative way. The symbiotic relationship between the cities, I think, is clearly going to be one of the most important ways for Milwaukee and the whole Great Lakes region to grow. But nevertheless, if you take a look at the chart, you'll see more tenants planning to move to this market. And there, in addition to those markets, you see Dallas, you see Phoenix, you see Atlanta, you see Houston. You want to get on this list, Milwaukee, because this is how activity is done. People move to the markets where they have good demographics, that have high talent bases, and have a low cost of doing business. And this shows up in the movement. These are the places where people are moving to Charlotte, Phoenix, Denver, moving out of some of the high-cost Eastern and some Midwestern cities. So again, need to find a way to stay off this list, give people incentives to come to town. Pent-up demand. What does pent-up demand mean? Well, my good friend and colleague over in Hong Kong, Henry Chin, coined a term, and he calls it revenge retail. What is revenge retail? Revenge retail is that people are lined up wanting to buy stuff when they've been cooped up in their houses for a long time. This is luxury stuff. This is restaurants. This is everything. You guys remember there was a movie in the 1980s. It was called Wall Street. And Wall Street had a tagline. And the tagline was, greed is good. Greed works. Well, I'm not going to sit here and tell you that greed is good, because greed ain't good. But greed does work. It means that people will be motivated by greed, by value, by able to get a great deal. And it will improve the economy. What's my best example of this? By show of hands, I want everybody to raise their hand right now and say, I want to get on a cruise ship. Since I can't actually see you, I can't see any hands, but I imagine I wouldn't see too many hands anyways. So I got the one and only one hand up. Why is my one and only one hand up? Because I want to get on a cruise ship. And you know why? Because I'm motivated by value. Does anybody here want to guess what the price is to get on a Carnival cruise line today when they start sailing again in whenever, October, November? To go from Fort Lauderdale to the Bahamas? Anyone? Anyone? Bueller? $129 per person. Let me tell you something. For $129 to cruise for 3 days on a nice ship to the Bahamas, people are going to get on the boat. People are going to price their services down to zero. Let me give you another example. The ICSC did a poll about a year ago and asked Gen Zers why they buy stuff in malls. And by the way, Gen Zers are the #1 age cohort to buy stuff in malls. You know why they buy stuff in malls? There are a lot of great reasons. Buying local, buying natural goods, all these things are good motivations. The #1 motivation, cost, value, period. The desire to get things at value is going to bring the economy back faster than you think, as certain services can price their goods and services to zero to build market share. And that's what cruise ships are going to do. But not all hotels are going to come back quickly. Hotels are by far the most distressed asset class. You can take a look at this as the overall industry about how low occupancy is, how low revenue is per available room. Folks, hotels have to be broken into 3 categories. Drive-to staycation hotels, business hotels, and international. Clearly, those last two types of hotels are not coming back anytime soon. And based on our home forecast for CBRE, we believe that the most distressed hotels may not come back till 2024. I just saw an article this morning. I was reading the Wall Street Journal about the Palmer House in Chicago. Just went BK. When BK, or rather the landlord and the tenant are in a dispute over paying the mortgage. The hotel today, based upon the appraisals, is worth $305 million. Pretty valuable hotel. It's worth almost $500 million 18 months ago. That's the kind of value fall off we've seen today because of NOI challenges at these hotels, and it's going to continue for some time. But mark my words, Mr. or Ms. Price It to Zero is going to get people back into these hotels. Certainly the traveler, the leisure traveler, is not going to get the big picture business traveler or the international traveler back fast enough. Hockey stick. One of the things we talk about in economics a lot is hockey stick growth. And what is hockey stick growth? Hockey stick growth is when you have outside growth and will it continue? That's what everybody wants in private equity, in venture capital. They want hockey stick growth in market share. When you see that hockey stick growth, that's when you get, aha, this is going to continue. And where are you seeing hockey stick growth right now? You're seeing it in e-commerce penetration. This year has been an unbelievable boom in e-commerce, not only for goods, but as many people are aware, for cold storage and for other forms of food delivery. Will this continue? Okay, folks, here comes your first aha moment. You heard it here first. You're not going to have hockey stick growth in 2021. You're going to have hockey stick growth negative in e-commerce penetration. You're not going to continue to see this line. And no, you're not going to see the line flatline at around that 25-30% penetration level. It is going to be at a higher plane than it was before, no doubt about it. But it is not going to be as high. So bricks and mortar will come back. And people are going to be spending. People are already spending. If you take a look at spending last month, you'll see that people are already spending more money this year than they were last year overall. But unfortunately, not all that spending, or most of that spending, is online, not in the stores. As you can see, foot traffic has been very, very poor. It's about what it was last year in grocery center, which is the dark green line. Malls are slightly coming back. Power centers are slightly coming back. But again, what I really don't like about this chart is I don't like the little tail part of it. You want to continue to see things going up. And unfortunately, we flatlined a little bit in terms of total traffic. And a lot of this is by market. You take a look at Houston versus New York, you see them coming back much faster than New York City. Now, I will tell you that I was on the phone last week. I did a gig for the University of Texas, and doggone it, get me a gig up there in Milwaukee and I'll teach at your university too. But I was doing a gig for University of Texas, and I was speaking to the guys on the phone. And they were telling me that all their kids are back in school. All their kids are playing football. I don't want to cast aspersions anywhere. I don't know if people are playing football in Milwaukee. They're certainly not playing football right here in Baltimore, except our pro team. The bottom line is that a lot of the things that we talked about before, about the restrictiveness of the lockdown, ease of doing business taxes, unfortunately, a lot of them go together. And it's causing a lot of these southern economies to bounce back quicker. Now, I mentioned cold storage before. Now, a lot of people said, oh, this is the great next asset class. Well, you know who said that? We did. We wrote a great report on. My terrific colleague, Matt Wallachek, lives in Chicago, wrote that report. But here comes the first shameless plug of today's presentation. Shameless plug number one. We had on our podcast a couple days ago, Fred Bullard, the CEO of Americold, the largest owner of this stuff anywhere, cold storage. You know what he told me? He said that notwithstanding the surge in home delivery of food, people still eat 3 meals a day. They don't eat 4. What does that mean? It means that we have not increased aggregate demand for cold storage. We have shifted that demand. And that's why people need to be careful when they take a look at these headline trends and think that it's going to lead to the demand for more real estate product. I like cold storage. I think it's a great sector. but it's very, very high operational costs. And then a lot of cold storage isn't really a retail product. It's a supply chain product. So most of it does not deliver goods from the store to your home. Most of it is deliver goods from the point of origin, which the point of origin could be a farm, to the next place, and then somebody else brings it to your home. You know what the best cold storage place is in America right now, and probably always will be? The back of the grocery store. That is a direct competitor for some of these modern cold storage facilities, because people can get the goods there and buy it in the store. They can deliver it from the store, and they already got the stuff there. So think twice about cold storage. Great sector, but be as discerning about it as I am suggesting. So let's sum this thing up now. We had a good discussion today about the future of real estate. And to sum it up, I will say that we remain optimistic on the recovery, though not as optimistic as we once were, because the shutdown is lasting much longer. Have not gotten the disease under control, though we do have the great possibility of a vaccine coming sooner. So it's a little bit of yin and yang. But overall, we're slightly more pessimistic today. But nevertheless, we expect a 5% drop this year and a 5% growth next year. The second thing you need to think about is the secular shift, the want versus need of real estate. You need to be in multifamily. You need to be in industrial. You don't need to be in office, hotel, or retail. Now, does that mean saying get out of those classes? No. And the reason is because people want to be there. And why do people want to be there? Because it makes them more productive. As I said, Harvard Business Review said people focus on productivity, not efficiency. And that's going to continue, and people are going to want to go back to their office like I'm going back tomorrow. I want to go back to my favorite restaurant. I want to go to hotels because it makes me better. And that is the bottom line. Commercial real estate makes people better in all the ways that matter. We're going to be in a tough road for the next 12 to 18 months, but we're going to come back. And to quote Jerry Seinfeld, we're going to go keep going with New York City if that's all right with you, and Milwaukee, you keep going to. Thank you very much. That is the way forward. Go commercial real estate, Wisconsin.